All right, we're going to learn about investing for this video. A few things before we get started. One, make sure you're asking your question, but when you're asking your question, try and keep your question on topic, and then at the end, let's go over all the random questions. So I'm going to give you a quick overview so you kind of know what we're going to talk about when we're going with things, but make sure you ask your question at some point, and if it is relevant, make sure you ask it because I'll try to get to it, and then if it's something that can wait for another topic, ask that later. And then at the end, ask all your questions, and then we'll just have a good time going over all your questions. So another thing to note is that I am, this is not financial advice, so I'm not professionally trained or anything. I just really like investing, very interested in it. So don't, everybody's going to have their own opinions. So just because I say I like something doesn't mean it's going to be a good investment. So just keep that in mind, right? So you do your own research. And yeah, let's jump right in. All right, so what we're going to be going over today is why people invest. We're going to look at investment accounts and what those look like, where you can invest, so where you can put your money in, right? Some capital gains, taxes, and that kind of stuff. And then a little bit of application at the end for what I would do if I was in your guys' situation. So that is a broad overview. So let's think about why you're going to invest. The reason for investing is, well, to make money, and particularly to make money for retirement. So there's lots of reasons you can make money for not retirement, but in general it's to make money. And most of the time people are investing because they're trying to retire at some point in their lives. So that's number one. I have Social Security on here. So Social Security is paid to older people to try and help them out so they don't starve to death, because as you get older, you can't work as much because, you're getting old. So Social Security right now is losing money. And in my opinion, it's going to be greatly reduced by the time we hit that age. So I am not relying on Social Security. I'm going to try and get my own retirement taken care of. And if Social Security is still around, then great. But I wouldn't rely just on Social Security to be fine in retirement. So let me switch over here. And what we're going to do is just a quick retirement calculator. So let's calculate for you guys here. And this is just going to look at how much money you actually need to have. So let's say you're 20 years old. And this is actually not the best way to do this, but let's just go for it. Let's say you're not making very much. Let's say you're making $12,000 a year. Current savings is $1,000, let's say. And so what this is saying is by the time you retire, you are going to need right here. Oh, you can't see it. It's very low. Well, it says 1.5 million right above this line here. So you're going to need about 1.5 million in retirement. And if you, at the age of 20, had $1,000 in savings and you were putting in $100 a month, you would get to about 0.4 million. So you'd get quite far. But obviously you're going to make more money in the future. So let's use my numbers for that's something I can understand a little better. So let's say I make about $30,000 a year. Current savings, I guess I'm just going to tell you guys everything about me. But I probably, if you add it all up, have about $20,000 saved. So if I am 29 years old, making $30,000, and all this is the same, it says I need about 1 million here in order to retire. And if I'm putting in $250 per month, I will have about 0.71 million when I retire. So that means I need to put more money away. And retirement age is 67, by the way. So that's why it's saying by the time you retire. So I'm going to have to be putting in about $400 a month at my current rate in order to retire. Now, in the future, I would like to be making more money. So if I typed in 60,000 here, let's try that. As you can see, this number the amount that I need to retire went from 1 million to almost 2 million. The reason for that is it's showing you if you want to continue living at your current lifestyle, you're going to need double the money because now I have double the income, so double the lifestyle. So keep that in mind. Most of you, if you're retiring and you're doing it appropriately, are going to have about $1 million when you retire, and you're going to need at least that because of inflation. It sounds crazy, but most of us will be, quite wealthy in the future. So got a lot of questions. Let me get to those. I'm going to have to get to those at the end or at some point here. So, okay. So the other aspect that I wanted to show you guys about, which I have right here, is compound interest. And this is really where we are getting our major benefits, is from compound interest. So let me show you how this works. So what you do is, let's say you're you, right? And let's say you don't have a whole lot of money. Let's say you have $500. So you put $500 in the bank and you're working part-time. Maybe your parents are helping you a little bit through college. And so you have $100 that you can put into investing. So what compound interest is, if you remember the penny experiment we did in class, where if I gave you a penny and doubled it every day, by the end of the month, you would have like, I don't even know how much, like hundreds of thousands of dollars, right? And the idea is, when you earn money, you go to work, you make money, you can put that money to work for you so that you don't have to work to make more money. So a lot of times people say this is the rich getting richer, but yes, that's partially true. But if you're poor, investing is really important, because then all the money that you make, you can start putting to use. So even the poor can get richer as well. So it's not only rich people, although they do have an advantage because they have extra income. But let's say you put $100 away and you do this for 40 years, all right? And interest rate, this is, we'll talk more about interest rate. This is how much, so like if the interest rate is 3 and you invested $100, at the end of the year you would get $3. You'd have $103, right? So this is a good average number for dividends, I would say, which we'll learn about later. So if we calculate this, the important part that I want to show you here is this blue line is how much money you've actually put in over those years, right? If you've only put $100 in and you started with $500, put $100 in every month, by the time you're old, so this is over 40 years, you put in almost $50,000, but it's worth almost $100,000. So you're pretty much doubling your money as you invest. And so that's what we call compound interest. The more you put away, the more that compounds, the more money you make in the long run. So that's what we're trying to do here with investing, is let money work for you. Okay, I'm going to browse the questions real quick, and then I might ignore yours for now, and then I might get to it later. So, is it smart to invest if you don't currently have income? It depends how much money you have saved. So right now, because the stock market is down, I'm actually I am investing in some things. I'm still kind of waiting, and I do have income. But my roommate, for instance, he doesn't have income right now, and he's still investing. So just depends where you're at. If you don't have money to invest, then your goal should be to build up your financial stability. So we have right here, working on that 6-month emergency fund before you invest. On top of that too, it might be a good idea to start working towards, you guys couldn't see that. Let me switch this over. Working towards this 6-month emergency fund would be a good thing. But if you don't have income, I think a better idea would be figuring out how you can get income rather than trying to think about investing, because you're going to have to get income at some point. So, okay, I'm going to have to leave these comments because we got a lot of them. So I'm going to have to go over those at the end because it's just a little overwhelming. So, all right, let's talk about accounts first, and hopefully I answer some of your questions while we go. So we have 3 main account types with investing. And the first, and I guess not the best, but the one that's really good, in my opinion, is 401k. So you get a 401k from most jobs. Typically, you can open up a 401k if you have your own business and use it to help your employees. But typically, when you're an employee, like a full-time employee, a lot of career jobs will have 401ks. And what this means is the company is going to kind of help you invest. So this is an account that your business will open, and they will take money right out of your paycheck for the 401k. So you make money, and you can say, each paycheck I want to put $100 in to the 401k, and a lot of times they'll do it all for you. There will be some fees, but it's a pretty easy, passive way, and this is a great, easy vehicle for you to start investing and for you to not have to worry about anything. Because most career jobs, if you go to work there for 40 years, put in a good career, you're pretty much going to be able to retire. And a lot of these they'll just have like investment plans. There are some fees, but for the most part, it works pretty well. The important thing to know about 401ks is that you get employer matches. So the company, if you are going to invest your money in their 401k, they'll actually help you out. So they're going to actually pay you to invest, which is awesome. So you'll get something like this. They will say, we will match 100% of 3%. So what this means is if you put in 3% of your paycheck, right? And let's just say, to make it easy, you're making $100,000 a year. So 3% of that is going to be $3,000. So if you invest $3,000, the company will match that and they will put in $3,000 for you. And so this is free money, and it's free compounding money, because this $3,000 is going to grow as whatever you invest. If that increases in value, as you get dividends, as you get interest, this $3,000 is going to grow, kind of like that graph we just saw. So you're getting free money with a 401k. So the first rule, if you have the option of getting a 401k, is to take the whole employer match. So if the employer match is if he's gonna match you 100% of 3%, take that whole thing and make sure you're investing 3%, because that is free money. Sometimes they'll do something like they'll match 50% of 6%. And so in this case, what this means is you can put away $6,000. So out of your $100,000, you invest $6,000, and they'll match 50% of that. So they'll match $3,000 as well. So 401ks are awesome. I hope to have one someday. We'll see. So there's that. Let's see if I can get some of these. Okay, so we're going to wait on those questions, and then I'll get to those because it's a lot. Okay, so your next one, let's say you don't have a 401k yet. You have an IRA. This is called an individual retirement account. And the reason why some people open up an individual retirement account is because the government wants to incentivize people to save for retirement. And so they've said that every year you can invest $6,000 into your individual retirement account, and you will not have to pay taxes on that. You won't have to pay income taxes. So if you made $40,000 last year, you got to pay, your taxes on that $40,000. But if you put $6,000 of that $40,000 into an IRA, when you're paying taxes, they actually minus that $6,000. So you only have to pay taxes on $34,000. So there's real tax benefits to opening up these accounts. Again, you can buy all kinds of different things within an IRA, which I'll talk about later. So you can have bonds, you can have stocks, you can hold gold, all these different things inside of an IRA, and you still get that tax benefit. And then the other account, and this is what I recommend most for young people to start out with, especially when they're not making very much money, is a Roth IRA. So same thing, you can put $6,000 in your Roth IRA, except you're not getting any income tax reduction like on the IRA. What you're doing is at the end, when you fully retire, you don't have to pay any taxes on taking this money out. And I'm going to talk about how you get taxed when you take money out of retirement. But with a Roth IRA, you do not get taxed taking money out. So this $6,000 that you put in every year, it gets to grow every single year. And then you don't have to pay any taxes on that. So for most people, they want to start with a Roth, then move to an IRA. Unless you have a 401k, then you take advantage of that because you're getting free money from your employers. So I recommend a Roth IRA for most people. And yeah, you can max out at $6,000. So what you can do, like for me, for instance, let's say I get to the point where I'm making $60,000 a year. I would be maxing out my Roth, right? So I'd be maxing out my IRA. Let's say I don't have a 401k. Maybe my business takes off, right? So then that's $12,000. So I would still have $48,000 to live on, and I would be investing another $12,000. We also have, you can do like a health savings account. That'll be another write-off, but you can watch the tax video if you want to learn about that. Those are the accounts that you can do. So inside of these accounts, you can own a lot of different things. A lot of times with the 401k, the company is going to give you like 2 or 3 options of what, like if you want an aggressive or a safe type of investment. With IRAs and Roths, you can decide what you want to invest in, so you can control your account, or you can pay people to invest for you. So let's look at what we can invest in, and then we'll talk more about how you actually invest. So all kinds of places to put your money. Basically, when you're investing, you're finding a place to put your money, and you typically want to put your money into things that are not going to lose value. So investing in a new car is not necessarily an investment unless you're going to use it for business or something, because a new car, as soon as you drive it off the lot, loses a lot of value. So these are things that when you're investing, they typically gain in value. That's what you're hoping happens, because that's going to make you more wealthy. So you work, you get paid in dollars. Some people, investing is risky and it can be scary sometimes. So people think, well, I'm just going to hold US dollars. the problem with dollars or any currency, for the most part, at least current government currencies, decrease in value by about 3% a year. It's been a little bit less recently because the economy is doing pretty good. The dollar is pretty strong, but basically the government is printing money, particularly right now because we have some financial issues. And the more dollars they print into circulation, the less value each single dollar that you have is worth. So over time, 3% every single year, you're going to be losing lots of value. So you still want dollars, especially for your emergency fund, but they're going to be losing value over time. We do live in the US, which means we have a pretty good currency compared to the rest of the world. And so it's fairly secure, right? The euros pretty secure. The yuan or whatever, the yen or whatever you call it, the Chinese currency is it's better than some currencies. It's not one of the better ones in my opinion. So anyways, there's dollars. And what you want to do is you want to have some dollars, right? But then you want to start moving your money into other ways or into other things. So one, CDs. These are called certified deposits or certificate of deposits. And so what this is you can get one at your bank. So if you have a bank account, you can just go in and say, hey, do you guys have any CDs? And basically what it is you will pay them a certain amount of money. Let's say it's $1,000. They will take that $1,000 and they will lock it up for a certain amount of time. What you're doing is you're telling the bank, hey, here's some money. I'm not going to need it for the next year. Let's say you lock it up for 1 year. And then they are allowed to loan it out, make money with it, and to reward you and to incentivize you, they give you some interest. So current rates on CDs are not that great. We don't need to get into why, but the government has been lowering interest rates to try to help the economy. But you're getting about 1% in a CD. So let's say over 1 year you get 1% on your $1,000. What that means is you give a bank $1,000, you can't touch it for a year. But in a year, they'll give you 1%, so that means they'll give you $1,010. So that doesn't look like a whole lot. You made $10, but when you think about higher quantities of money, you do actually make some money. But this is a good, safe, easy way to start and start learning how to do it. You're not getting great interest rates. Back in the day, banks used to give you like 4% for holding your money there. Now they give you like 0.02% or something, which is essentially nothing. So, you don't get a whole lot of benefit from doing that. Next, let's look at bonds. So bonds, these are kind of like loans that you give to either corporations or to the government. You can buy government bonds. And this is kind of like CDs, but sometimes longer. So you can buy like a 10-year bond, right? So maybe you put $1,000 into that bond, and after 10 years, you can cash it out for $110. So that would be, again, a 1% interest per year, $10 over 10 years. That's going to be $100. So you made $100 by not doing anything at all, really. Personally, I'm not a huge fan of bonds because I'm young and it's low risk, not very high reward. Some people do like bonds, especially as you get older. You typically want to start moving your retirement into safer things like bonds and CDs so that you're not losing money, so that you have it when you're there, because the stock market can crash, right? Like it is kind of doing right now. Another option is gold. So you can buy a precious metal. The reason why people do this is because it holds value. So I actually have the gold chart up. Let me show you guys that. So over here, and this is just kind of helping you guys, I guess, read markets. So right now what we have here is the price of gold per ounce is $1,685. And this blue graph down here is showing us that. So right now the price is $1,685. A week ago it was $1,718. A year ago it was $1,200. So a year ago, if you would have bought 1 ounce of gold for $1,200, today you could sell it and you can make $400 on that. So if we compare those prices to this over here, you're making quite a lot more money, right? Because you invested $1,200 and a year later you came away with $1,600, right? Although that's not always the case, because you could have bought at $1,200 and it could have went down to $800. So there is risk when you're investing. So just be aware of that. There are safer things to invest in. There are more dangerous things. Gold tends to be fairly safe, but I'm not a huge fan of gold. Some people really like gold. Everybody's going to have a different investment strategy. So next step, You can buy a house, and this is good because you can live in it, and then your house hopefully gains in value over time. Typically speaking, that's what happens. You can also invest in real estate by ETFs. So you are giving a larger company money to invest in real estate for you. So if you can't afford to buy a full house, you can still get exposure to the real estate market. We'll talk about that a little more in a second here. Next, we have index funds, ETFs. This includes mutual funds as well. These are kind of groups of companies that you can buy to make money. So index funds like the S&P, I have that up here actually. Let me show you guys that. So the S&P, they call this one the SPY. So the S&P 500 is 500 companies you can invest in. And this is what it looks like over the last, I believe this is the last year. Yeah. So this is when we peaked, and then when we shut down our economy, the S&P plummeted, right? So it was worth, this ETF was worth $337 back in February. It crashed down to $223. It's back up to $283. So that's kind of how you can get money when you're doing this. Some of these can also pay you dividends. So on top of this, maybe let's just say, for instance, that the S&P gave you a 3% dividend, which I don't know if it does give you a dividend. Some companies will give you dividends. We kind of learned about that. That means they'll give you 3% of whatever your share price is, or however much you own. So if you owned, let's go back here. So there are two ways you can increase your value. One is by maybe you bought at the bottom here. Let's say you bought the S&P at 222. Today, you would have made $50 in like a month, right? Off of 200. That's not too bad. So you make money by the company's stock going up, but you also get dividends paid out. So if they paid you in dividends, let's say you had $1,000 in the ETF, and they paid you 3% per year, then at the end of the year, you're going to have $1,030. And that's where that compounding goes, because then the next year, you're going to get more than $30. You're going to get $1,066 or something like that. And then you're going to get $1,000, probably a little bit more, right? So that's how it kind of compounds. So index funds, ETFs, I'm going to show you my actual account and how I buy ETFs later on, because I'm a big fan of buying multiple companies, because I don't have the time to sit and evaluate every single company. I would rather have an ETF or somebody else do the research, and then I'll just trust their data and buy into the sector that they're invested in. So I'll show you those. Index funds and ETFs are typically made up of shares and stocks, right? So a stock is a share in a company. And so you can buy, I've been looking at Home Depot, right? HD. So you can buy part of Home Depot. As Home Depot does better, as they make money, they pay you money and your value rises. And then the last one is cryptocurrency. So everybody loves to talk about cryptocurrency. I am a fan of cryptocurrency. This is kind of like a dollars, but it's a currency that's not controlled by governments. It's a new asset class, which means it is high risk, which also means there's higher reward. The saying goes, if you're investing in risky things, is never invest more than you're willing to lose, because if you're buying Bitcoin and if Bitcoin goes to zero, then you basically lose your money. I mean, the same thing happens with stocks and stuff, but whenever you're looking at new industries, it's always riskier. There is some research that shows if you put 1 or 2% of your portfolio in cryptocurrency, it can stabilize it so that you're not so risky. And a good way to think about that is when you're getting older and you're having lots of money, is you're going to have a bunch of different vehicles of investment. So you'll have some dollars, right? You'll have maybe, who knows, an emergency fund for a family should probably be about $20,000. You could have some CDs, you could have some bonds, you could own a little gold, you could have a house, you may have an IRA with some stocks, you might have 1 or 2% of Bitcoin, right? You can mix and match however you want for this. So, okay, that's kind of where you can invest. I've kind of ordered it from low risk to high risk, so you can see that there. Okay, let's move on here, and let's look at how you can invest, and then I'll look at some capital gains, and then I'll get your questions because we got a ton of them. So, all right, so you are young and you are looking to invest. So the first question is, like our first question actually was what if you don't have any income? Well, you need to find a way to get income then if you want to invest. So the way that I would get into it, let's say you do have a part-time job. You need to make, well, an initial deposit. So let's say you have some money in the bank. Let's say you have $3,000 in the bank. Okay? And if we're looking at, where is it at? Our financial stability thing, you want to make sure you have at least $500 in the bank that you never go below. So you always have $500 in the bank. You want to have an emergency fund in case anything happens. So in my opinion, you should have at least $1,500 in the bank, just to kind of be safe. If you have lots of student debts, you should probably be paying those off before you get into the investing world too much. You can do both at the same time, so I don't want to dissuade it, but think about paying off that debt first. You can do both. If you have family support to back you up and you know you're not going to starve or anything, then you don't necessarily need this 6-month emergency fund. I do recommend it just so you can be financially independent. It feels good to be financially independent and be okay, if you lose your job or something. So I do recommend getting this. But if you are young and you just have a part-time job, your parents are helping you through college, and you know you're going to be fine, you probably don't have to get all this in before you start investing. So let's say here you are, you got $3,000. You're fortunate enough to have some family backing, so you're not all on your own. And you have a part-time job, or maybe you make $300 a week, let's say. Let me switch pens. I'm starting to lose life there. So in my opinion, what I would do is maybe start a Roth IRA. Again, one of the things I should mention about those IRAs and those investment funds is you need to leave them in there until you're 67. You can pull them out earlier for certain situations, like if you have a Roth IRA and you're a first-time homeowner, they will not penalize you to buy a house. So if you want to buy a house someday, I recommend starting a Roth, and you can roll that Roth over into a house later on, if that's what you want to do, without penalty. If you do want to access your money, you have a 10% fee on that, and you might have some taxes, which I'll talk about in a second. But you're kind of locking your money up for a little bit. You can get it out for a house, so be aware of that. So I would start a Roth IRA. You can do this on websites online. So Fidelity is what I use. They got TD Ameritrade, Charles Schwab. There's Robinhood, although you can't open up an IRA on Robinhood. But I should mention that right now. So if you don't want to be locking up your money for 67 years, because that's or for 47 years or however long until you're 67, you don't have to invest in an IRA. You can just buy stocks on Fidelity, on Robinhood. Robinhood doesn't have IRAs, and it's just an app on your phone. I'm kind of a fan of that. I actually have a link below. You can sign up, and if you sign up with my little link, you and me both get a free stock, so that's kind of fun. So I'd recommend getting a Roth. I like to go through Fidelity because when I signed up for this maybe 2 years ago, there was no minimum investment amount back in the day, and still on some websites you have to put in $4,000 in order to open up an account. Nowadays there's no minimum, at least on Fidelity, and there's no trading fees. So what I would do just to get started is you can just put $300 over to Fidelity. So you sign up. Let me actually show you my account here on Fidelity. So this is fidelity.com. I'm already logged in, and I guess you can just open up an account, right? And so you link your bank account, enter in some information, and then now you have an IRA account. And within this account, you can buy different things. So let me just click on my portfolio. This is one of my accounts, so I guess you're going to get to see that I have some money in this one. So I have $2,600 in this one, and these are the different things that I bought. Obviously, the stock market isn't doing great right now, but what you would do is you'd put $300 over here, and then you can start buying things, whatever you want. So you don't just put your money in here and let it sit. You put your money in here, and then you buy something. So you can buy Starbucks, you can buy gold, you can buy different ETFs, and I'll show you that in a second. So let's go back over here. So let's say you put $300 in to start. All right. So boom, there you go. Now you have a little bit of money to mess with, and you can just kind of learn. So what I would do is I would make very small purchases right away. So if I show you back to this, I like this ARK Invest company right here. So they have a bunch of different ETFs, ARK K, ARK G. Let's look at ARK Q. This is one of my favorite ones right now. It's $35. So I can buy one share for $35. So if I bought one share for $35, then boom. If it goes up to $50, now I've gained $15, let's say, and now I have $315 worth of value, Remember, you can also lose value, which I am losing value right now. So I would just bring over a little bit to start. You can start with 1,000, however much you want. The next step is reoccurring and just continuously investing, because it's good to just send a little bit of money over from time to time. So let's say you're making that $300 a week still at your job, and you can maybe spare $25 a month. Not too much, because you need most of your money. Let's say you can budget in $25 to invest. So you can set it up to automatically transfer from your bank to Fidelity. So every month, $25 gets added to this. So now you're at $325, $350. Pretty soon, after 4 months, you got $400 in there. So that's how I recommend starting, is just getting an account and then just getting a slow investment over there. Same thing if you have loans. Maybe just send $25 off to pay your loans too. So maybe if you want to do both at the same time, $25 towards your loans, $25 towards that, you get to keep $250 a week. So you're still making $1,000 a month, and you're investing $50 in paying off your loans and $25 in paying off your loans, $25 in investing, to get $50 overall. So that's kind of how you can start building your wealth at the start. Okay, what I'm going to do is I'm going to show you how you can actually buy on Fidelity. I'm going to actually buy a stock for you guys, or an ETF actually. And then I'm going to go over some taxes real quick, and then I'll answer your questions. I know it's getting a little long, but most people are still here, so I think this is some good information. Okay, so Fidelity, you can't see where I'm going, but up in this corner, there's this little search bar here. And let's say I wanted to buy some Home Depot. So I type in Home Depot, and then I clicked on Home Depot. And here is going to be a bunch of data and analysis on Home Depot. So a good thing to know is you're going to see all kinds of people on YouTube saying that they can show you how to invest to make money. People are notoriously wrong, so don't just listen to people. Oh, here we go. Here's Home Depot. Sorry about that. You can just search this on Fidelity's website, right? Or any website to find the share price. But don't just listen to other people who are reading charts and all this stuff. For the most part, you just want to keep consistently buying, and long-term, over the long haul, you're going to make money if you don't get too crazy with stuff. So this is Home Depot. It's $200 today. If I click, you can't see it over here, but there's a little buy option behind my photo that I would click to buy. So I don't want to buy Home Depot. That's a lot of money right now, and I think it might go down more. So I'm going to just buy an ETF. So I like this one called ARKQ. So again, up in this corner, I'm just typing in ARKQ, which is the 4-letter symbol for the stock. As we see, it is $35.64, and it'll give you a bunch of information. Basically, it'll tell you, so this is an ETF, which means they're investing in a lot of different companies. So right here, we can see 14% of this ETF is in Tesla. So if I don't want to buy a full share of Tesla, I can buy a share of this ETF, and now I just have a tiny portion of Tesla. They have Proto Labs, they got Stratus, a bunch of companies. These are like tech companies, right? It is a technology and robotics ETF. And so I'm pretty interested in this kind of stuff. I think it's going to be the future. And so I'm kind of a fan. So I'm going to click buy here. And now we get this little thing. So what I'm doing is I'm selecting my Roth IRA account. And again, because I don't want to pay taxes in the future. And I already have money on my account because I sold some of my my stocks before the market crashed because I saw coronavirus coming. So I have $1,000 in my account of just dollars that I can spend. And so down here we have buy. So I'm going to buy one share. So that'll cost me $35. I'm just going to do a market order. So this just means they're going to buy it at whatever price it is, within this range. And then it's going to buy it within the day. So the stock market closes at night. So you can set limit orders. So maybe I want to buy ARK at $30. I can say buy 2 shares at $30 whenever the price hits $30. So I do have some of those set. But let's just buy one at market order here. Preview order. So it says warning, you're about to purchase this. And so it's going to cost me $35.64. Place order. All right, so my order is received, and in about a day or two, they will purchase it for me, and then it'll be added to my account. So it's that simple. But the hard part and the confusing part is figuring out what you actually want to purchase when you're doing all of that. So, okay, one more thing. If you're thinking about day trading, before I answer your questions, so with day trading, you you got to be careful because it's not just all free money, because if you are trading a lot, you are making money, and then you're going to have to pay capital gains. So the way this works is if you buy, so I just bought that ARKQ stock, right? And let's say I sell it tomorrow. This is going to be a short-term trade because I held it for less than 1 year. So this is less than 1 year. And what that means is they're going to treat it as if it's income, because some people, their jobs are just day trading all day. They're just buying stocks and selling stocks, and that's how they make money. As stocks go up, they sell them. As they go down, they buy them and repeat. So if you are doing short-term day trading, you're going to have to pay taxes on that. So just be aware. And the tax rate is the same as your income taxes. So the more money you make, the higher income tax you have to pay. So the taxes are quite high for that. However, if you're doing long-term gains, which is what you should be doing, is once you've held that stock for over a year, you do not have to pay taxes based on your income. So if you make less than $40,000 with your income and the money you're taking out in investments, you are not going to have to pay any long-term capital gains on that. So this is in place for people who don't have a lot of money, who are investing for retirement, and once you retire, you're not having a whole lot of income. You can take $40,000 out of your investment or your retirement account to live on, right? Tax-free. So that's pretty nice. So you want to think about investing in the long term. If you are more wealthy and you're making $40,000 to $440,000, any money you take out is going to be taxed at 15%, and then above $435,000, you're going to have to pay 20% tax on that. So don't just start trading, a bunch of cryptocurrencies or a bunch of stocks and think that there is no taxes, because you are going to have to pay taxes on that. And I don't want to talk too much on this, but just be aware, have that knowledge, because when I started, I did not have that knowledge, and I had a very bad time when I filed my taxes because I didn't actually take any profits and I just owed a bunch of money. So be aware of that if you're trying to think about day trading. Make sure you understand how capital gains work. Okay, let's go over questions, and hopefully if I miss anything, you guys will have asked them. So I'm going to go, okay. Yeah, we have really good questions. So I'm just going to go in order, and then we're going to see what we come up with. So when should we start putting money towards retirement? Okay, so I would just follow this, where did it go? This financial stability for most people, right? Get that $6,000 and then pay off your loans, which you're doing here before that $6,000, and then start investing for most people. If you're really interested in it, I recommend just getting a little Robinhood account and putting $100 over there and just playing around with it. Be prepared to lose it, but just throw $100 over there and you can buy and sell and just try and figure out what's going on. All right. So, and then once you get a full-time job, you should be allocating money to go into your retirement account or to be saving it or whatever. So you should always be trying to find a way to save some amount of money or pay off your loans or whatever. At our age, what is the best amount to invest? So it's going to depend. I think just starting whatever you can. So if you can only put $10 away per month, I would put $10 away. And you're going to just get more comfortable with it as you go. Would you prefer a PERS plan or a 401k? I don't know what a PERS plan is. So let me know what that stands for, and then I might have a better idea. But off my gut, I would say a 401k is awesome, and I want one. So I would say 401k. When should we start thinking about investing more seriously? As soon as you have good income and your bank account is growing and you don't have a whole lot of debt, that is when I would start thinking about investing seriously, especially if you have a family. You want to be financially set up for yourself and for your family. So the sooner you start, the better off you're going to be, because the more time your money has to compound. So if you start when you're younger, you're going to be way wealthier with putting the same amount of money in if you wait until you're older. So how do we start a Roth without an income? If so, what is the minimum we should add? Okay, so again, I told you how to start a Roth. I should mention, if you don't want to do the online one, you can just go into a Fidelity office or a Charles Schwab office or wherever and just say, hey, I don't know what I'm doing. Can I sit down and figure out how I start a Roth? And they will actually help walk you through that. So if you don't have an income, it's hard to start putting money in. So in that situation, I would try to get a small side job with whatever you can handle and then start putting money away in your Roth. I mean, you're investing a lot of time in your education, which is an investment as well. So you got to determine where your money is best spent at the time. So it might be better working towards your education. But yeah, it's a hard question. It's going to be dependent on your situation. For how long should someone be investing for? Pretty much your whole life. As soon as you are able to start investing, you want to be investing pretty much until you're done working. I mean, that's not always the case, but for the most part, you should always be finding a way to invest. I mean, working is you're investing your time in making money, right, in dollars. And then once you have dollars, sometimes you want to move them out of dollars, because if they're in like a company, if you're a partial owner of a company, then you can make more money that way. What are the best things to invest in, like business-wise? I thought things that never lost value might be better. So things are never going to never lose value. So things are going to go up and things are going to go down. It's hard to time the market. So in my opinion, if you're just always putting in to like an ETF or like a S&P 500, Dow Jones, these are fairly safe models of investment. Yeah, I have a love-hate relationship with ETFs and index funds. Sometimes it's not the best, but they tend to be pretty good overall. So, and if you're overwhelmed by all this, you can pay somebody 1 or 2%, or like 1% probably, and they can do all the investing for you. So you can go into an office, say, hey, I want somebody to manage my investments, so I'm going to pay you, 1% when I finally file at the end or whatever, right? And then so you just send $40 into them every month or $400 in a month, and then they will put the money wherever they see fit because they're professionals and they know where the money's going. So if it's overwhelming, pay somebody to do it for you, and then you just send them the money and they will take care of it. So, and make sure it's a reputable company so you're not getting ripped off or something like that. My question was, what about what 3 stocks, if any, do you invest in, if you feel comfortable answering? Okay, good question, John. So right now, I feel comfortable sharing that. So I really like this ARC Innovation company. They have been doing very well over the last couple years. They have podcasts coming out every month. I have a link in the description below that you can check out, and you can just check out about the company. Doesn't mean they're going to work out, but they've been right about Tesla for many years when everybody was hating on them. So I'm a big fan of ARC. I want some Home Depot. But I think it's going to go lower. So under $200, I want to buy Home Depot. I would love some Tesla, but I think that's overvalued right now. What else? I wanted to buy AMD, who makes like computer processors. I was looking at them when they were $9 like 2 years ago, and I was going to invest, but I wasn't set up, so I didn't invest because it takes some effort. And because I didn't get everything set up, I missed that opportunity. AMD is like $50 now. So if I were to put $100 into AMD or $1,000, say I put $1,000 into AMD, I would have had like over $5,000 right now, 2 years later. So, yep. And then I really like Bitcoin, to be honest, right now, but I'm only putting in enough where I'm willing to lose it. So, I just think because we're inflating our currency, it's a risky move, but I'm willing to lose money right now to make more money in the future. So that's kind of what I'm looking at. All right. What happens if you do not ever invest? Is that uncommon for people not to invest? Yeah, so people don't invest sometimes. And then what happens is you get to an older age, and now you have to rely on the government to take care of you with, Social Security. And Social Security isn't in the best place right now, and so there are going to be some changes that are going to have to be made. And so who knows what life is going to look like when we are 60, 70, and 80. So personally, I'm not going to rely on the government for that. I'm going to hopefully take care of it myself. So there are people that don't invest, but you don't have your own finances in your own hands, right? You're trusting a government to take care of you, which, the U.S. government is decent at doing that. But I would be cautious about not investing. So when did you start investing your money, and how do you know at what age most people invest? So my parents really got me started young. I was delivering papers at the age of 10, and they had me go buy some stock. And I just walked into an office. The guy suggested what I should buy, and I put $400 in this little Pioneer fund. It turned out when I went to college, it was worth $600. Maybe 8 years later or something like that. So I got started young, but then I really started investing hard about 4 years ago when I was really poor, and I realized I didn't have enough money to buy groceries, right? And I was like, okay, I can't be poor anymore. So, so I was 25 when I really started going hard on investing. And I've made a decent amount of money. So I would suggest getting started when you're young. When we look at our financials, is it good to have a really diverse, risky portfolio young, or have a less diverse, more secure portfolio over time? So my opinion is to be risky while you're young, because if you make a mistake and you lose some money, you are still young and you can make more money. And then as you get older, you move out of the riskier assets. Like for me, Bitcoin is a super risky asset. So when I'm old, I mean, who knows, maybe it won't work out, but I would start moving my money out of riskier assets and into like stocks or like into bonds and stuff, because I don't make as much money, but it's going to be there for me, right? So as you get older, reduce risk. When you're young, in my opinion, you swing for the fences. Maybe you can hit a home run and you make a lot of money. And then with that money, you can, do all kinds of things, live the life you want. So that is my suggestion on that. Is the interest rate universal? No. So there are all kinds of interest rates out there. So let's just show you over here on this. So banks tend to pay right now like 0.01%. I got a pretty good bank where they're paying me 2%, 2.5%. Icon Credit Union, shout out. So credit unions tend to pay a little more interest. This still isn't great. CDs right now are not great. They're paying 1.4 interest. Different banks have different rates. So you kind of got to shop around for those and look into different things. So no, they are not all the same. Is it possible to lose money through investing? Yes, it is. And the way to think about it is if you buy, let me actually show you this. If you buy, let's say the S&P ETF, the 500 for $300, let's say, it can drop down to $200 and you still own one share of the S&P, or the SPY is what they call it. So you're still owning one share, whether it's worth $300 or $200. But if you sell, that's when you lose your money. So maybe, the market turned down right now, and so you lost some money there. It's going to go back up in the future. So let's say in 10 years, it's worth $400. Well, if you never sold, you didn't really lose money. You lost some value short term, but now you're up. And statistically speaking, over the long term, the stock market has gone up. If you're thinking about investing for 10 years in the future, you should be putting money in the stock market because historically it's gone up. So if you're investing in something riskier, like a single company, so maybe you bought Facebook back in the day when it was like just starting out, there's a high likelihood that Facebook would have failed early on, right? So you could lose all your money that way, but you could also become a millionaire because you bought a cheap stock. So beware of penny stocks. They typically don't work out. Penny stocks are very cheap stocks. Beware of those. In my opinion, stick with the main guys, like the Amazons, Apples, Googles. That's the safest way to do it, in my opinion. But yes, you can lose money. So if you're worried about losing money, I would go to like a tax professional, and then they'll be more knowledgeable on how to like be safer with your portfolio. So that's what I would do. When did you start investing in stocks? Yeah, so about 4 years ago, I started buying cryptocurrencies and stocks at the same time. So, and I just started on Robinhood. It's just an app on the phone. Again, I got a link in the description if you want a free stock. There's no IRAs through Robinhood, so I'm not a huge fan of it. I just have like $100 on it to mess around with, and it was kind of my learning, where I started learning, I guess you could say. But now I'm in that Roth IRA for the tax benefits. So, okay, let's see here. I got lost in these. Why do you think Social Security will go down in the future? So Social Security right now is spending more money than they're taking in. So right now, they're just, if you're running a business and it costs you more than what you're making, then you're going to have a problem. And because we have the baby boomers who are growing older, right, and they're starting to get on Social Security, there are a lot of them, thus the name baby boomers. People are having lots of babies, and so there's lots of them. So there's a lot of old people that are now starting to collect, and there are less young people, and particularly because the stock market's kind of down. I mean, job market was really good. There's not a whole lot of money going into the stock market. So the country is borrowing money to pay out old people, and they're borrowing it from us in the future that we're going to have to pay off in taxes in the future. So, you can make a moral argument that says it's stealing money from the youth, but then you could also say, well, we want to take care of our old people. So, yeah, the stock market or the Social Security is currently not making enough money. So in the future, I don't expect it to be that great or necessarily be around. So, okay. What does the interest rate depend on the bank you are with, or is it different with the stock market? So Yeah, so the interest rate depends on the bank you're with. Like I kind of explained, some banks are going to give better interest, some are not. It also determines the federal government or the Fed. They are giving money to companies, they're printing money, and they're choosing an interest rate. So they are determining, they're keeping low interest rates, which makes banks have to do low interest rates. As far as the stock market, they don't necessarily have interest rates. They have dividends. So the company gains value and loses value. That's one of the ways you make money. And then as that company makes a profit, they pay you a dividend, which is kind of like interest. They'll pay you like a couple dollars or whatever it is per like 3 months. Typically, they'll send out a little dividend check to you, or you can just reinvest it as well. So no, interest rates are not all the same. Okay, I already started my retirement account. So what would be a smart investment to make next? Okay, so you have your retirement account. So then you're just going to start putting money in that retirement account, and then you're going to start buying different stocks. I can't tell you what to buy. You're going to have to make that decision. So if you don't know, I would just watch some more YouTube videos. What do people invest in? I think ETFs and index funds are going to be a safer model because the S&P, it's hard to go wrong with the S&P 500 because you got 500 companies in there. If one goes bankrupt, you're not going to lose your money. And over time, it's always gone up. So Dow Jones, those are good, safe ways to start. All right, good. So, and again, you can buy other things within that. You can buy gold in there if you want. It's takes a lot of research to figure out what you want. You can buy Starbucks, right? I think large companies right now are decent buys, although I'm waiting for them to go lower before I buy them. Smaller companies, when the market goes down, is risky because they could go bankrupt. So. What is the difference between assets and liabilities? Like, why is it good to buy a house and not a car? So a house would be an asset. A car is an asset as well. Houses tend to increase in value. Cars tend to decrease in value when you buy them. So it's not that it's a bad thing to buy a car, but it's just going to decrease in value. So if you have lots of money, then you can go ahead and buy a car. The value that you lose for buying a new car is, maybe worth it for you. But for the most part, houses are going to go up in value. Cars are going to go down in value. If you bought a car in 2002 and it was brand new, it's worth way less. But if you bought a house in 2002, especially in Boise, it's going to be worth way more. So that's kind of why. Would you invest using money from your checking or savings? Doesn't matter. I only have a checking account. My savings account, I don't have to worry about that. It's just all my checking account. So mine comes from my checking, but you can link either account and they'll both work. So if we do not have a full-time job currently because we are in college, should we wait until after or start now? If you start now, will it transfer over to our future jobs? Yes, so it does follow you around, and you can roll your IRA into a new account in the future. So there are ways to transfer your money. So yes, I would start now if you have a little bit of income. Just $25 a month, you'll get a long ways doing that. Okay, so where am I? Okay, what are some options for investing now in college without having a full-time job? Just start really small is what I would say. $10 a month if that's all you can afford. I would start there because after a year, you're going to have $120 invested, and that's going to be making you money already. So in a year after that, if you only have that 120, pretty soon it might be worth 150, right? And then the next year after you put 120, now you got $300 in there. So that's what I would suggest. What is the major difference in investing in mutual funds or investing in individual securities? So mutual funds are going to be a group of investments, kind of like an ETF. They could have 10% gold, 10% real estate, 80% stock market. So mutual funds tend to be managed by somebody. They're kind of becoming a little bit outdated with ETFs now. I'm not real clear on all the terminology, so I'm not exactly sure what an individual security is, so I can't quite fully answer that question. How come your car loses value by so much when you drive it off the lot? Well, just because it's not new anymore. People are willing to pay a high price for a new vehicle, but as soon as somebody else has owned it, they don't know how that other person has treated that car. So you're kind of taking a risk buying a used car. So it's going to lose value because of that risk of you don't know what the previous owner did, right? Okay, what if you have an emergency and need money back from your CD? Are there options when something like this happens? Oh, great question. So with a CD, no, you're locking your money up for a certain amount of time. So 6 months, a year, you might be able to pull it out, but there will be fees. Same with an IRA. So that's why I like to have that emergency fund of $6,000 if you're an individual and up to $20,000 if you're a parent, just so you don't have to access those resources if you need to, although you always can, right? But you will have to maybe pay some taxes or some penalties on getting that money out. So you still have access, but not real great access initially. Good question. All right. What is the best way to start investing money in college with only a summer job? Yeah, again, just $10 a month or whatever it is, $25 a month. And if you can only invest in the summertime, then just put money in the summer. Just get started. Or paying off loans. That's an investment as well, paying off your loans. Can you explain a little bit about futures? Great question. So futures are buying things in the future. So basically with futures, what people will say is, let's say gold futures, right? And so what you're doing with futures is you're saying, hey, I'll pay gold today is worth about $16,000 per ounce or $1,600 per ounce. Let's say I think gold is going to go up in the future, or maybe I think it's going to go down in the future. What you're doing is you're buying, you're saying, okay, in 6 months, I'm going to buy gold from you for, whatever the market says, right? So the market says, in 6 months, I'll buy gold from you for $1,700. You're paying $1,700 thinking that in 6 months, gold might be worth $2,000 an ounce. So that's why people buy futures, is they're thinking, they're betting on the future. They're saying, I think gold is going to increase. If the future price is $1,700, the market thinks gold is going to increase to $1,700 in the future. But if it increases to $2,000, you're going to make $3,000 on that because you're promising to buy gold in the future. So things get very complicated when you start looking at futures. But if gold drops down to $1,400 in 6 months, well, then you're going to pay $1,700 for $1,400 gold in 6 months. So, I don't mess with futures. That's not my style. But I do your own research if you're interested in that. What are your experiences and thoughts on flipping items? So buying them for a certain amount and selling them when you bought them for. Great question. People are really good at it. I had a friend, he buys cars, he buys cell phones, and he flips them. If you can do that hustle and you know what things are worth, then go for it. I think it's a good way. People invest that way too, right? They buy houses and flip them. You don't need to be in the stock market. You can be buying houses. You can be doing all kinds of stuff. So, I think that's a good move sometimes. Would you personally invest while you have debt or pay off your debt first? I was doing both. So I was getting very aggressive. I was paying $500 off towards my debt, and then I was investing like as much as I could. Like it was probably when I started like $50 to $100 a month. I would do, depends how much debt you have and what the interest rates are. If you're only paying 4% interest rate on your debt, I would be doing a little bit of both. If you're paying a higher interest rate on your debt, like 7 or 8%, I would be doing your debt first. If you have credit card debt, which tends to be at like 25%, 22%, pay off your credit card debt first, get rid of those high interest rates, and then start investing. So, I did a mixed model. You have to determine what's right for you. Also, can you invest for someone else, like a parent buying a stock for their child's name? I believe so. I haven't looked into that too much, but yes, there are ways to do that. But you can like invest in a retirement or a college fund for your kids or whatever. So there are ways to do that. I'm not very familiar with them because I don't have kids, and my parents, I have money coming from them, I guess, but I don't know exactly how that works, but you can do that. Would it be too risky to invest in just one company, or would it be smart? So investing in one company, you have a higher risk, but if that company becomes a huge deal, then you're going to make lots of money. So it is risky. If you're going to do that, what I would recommend is investing in a few companies. So some safer ones and then maybe some riskier ones. So some Amazons, some Apples, and then maybe a new company that you think is gonna rise up, right? Because the younger the company is, the more likely it is to fail. Okay, so with the market being so low, should we assume that most stocks will come up once all this quarantine stuff clears up? Overall, yes, the market should come back. I think the market still has more room to go down. So I pulled $1,000 out of the stock market just to buy at lower prices. They went super low. I thought about buying. I decided to wait. The prices came back up. So I'm still waiting. But yes, what you should be doing is you should be buying just slowly every single month so you don't have to worry about the price. So the price is going to go up and down. You don't care. You put your $50, $400, however much it is a month into the stock market every single month. And then long term, you should make money doing that. So, and again, if you don't want to be trying to time the market and all this stuff, you can pay somebody to do that for you. I just tend to enjoy this stuff. But yeah, 10 years from now, the stock market should be higher than it is now. So if I'm living at home, should I invest all my money into investments instead of having an emergency fund? I would have a little bit of both. So have an emergency fund, but you're living at home and you don't really need it. You might not need a $6,000 emergency fund. So I would pay a little bit, maybe have $1,000 emergency fund, because I think everybody should have that at least. And then start investing the rest, especially if your parents got you. So what are your thoughts in snowballing your debt payments? So I believe you're referring to, please explain a little bit more on that. Snowballing your debt payments. So one of the things you can do is you can kind of roll your debt payments into other payments. So to get lower interest rates. So if you have a lot of debt and you're paying a lot of interest, sometimes you can refinance and you can get a lower interest rate, so you're not paying so much in interest. Snowballing, or you might mean with snowballing like paying a small debt or paying a small amount and then slowly paying more and more and more. That's a good way as you make more income. So when I was first paying off my loans, I was only doing the minimum, $50 a month. Eventually, I worked up to paying $500 a month. So, I think paying off your debt as soon as possible with whatever you're able to afford is always a good idea. So hopefully that answers that question. All right, well, this went a little long, but we had lots of questions. Thanks for asking those. I am going to sign out here. If you have more questions, feel free to ask, and I will be in the chat and I will answer those. But other than that, have a good day, and thanks for watching.